I've been studying and listening to central banks for almost a decade, and I found a pattern, a code. Every month, central banks get on stage and they talk a lot, and the market hangs on every single word they say. Literally, algos are programmed to buy or sell based on specific adjective they say. To trade fundamentals, you need to learn to read between the lines of what a central banks say. For instance, if Powell says we're worried about upside risks to inflation, he's basically telling you, I don't care what you think, I'm raising rates or keeping them high. That's bullish for the dollar. But I'm gonna tell you why and how you can actually understand this in a second. If he says instead that there's a sign of weakness or cooling in the labor market, he's basically telling you he's getting nervous about the labor market, so they'll cut rates. I'm obviously oversimplifying a bit here, but stick with me because this gets really useful. You can trade fundamentals if you know what to listen for. And you don't actually need to be an economist to understand what central banks say. Let me get to the meat of this. I'm going to give you the cheat codes. I'm going to show you how to read these guys, how to spot an important pivot, and how to position yourself based on what a central bank says so that you're swimming with the macro flow, with the central bank, and not against it. So this is the reality. You can be the best technical trader in the world. You can have your perfect support, perfect engulfing candle, everything's perfect. But if Powell walks on stage and he signals a move that goes against your position, then your technical get run over. So, to understand what a central bank say, you have to understand this fundamental framework. Every central bank, especially the Federal Reserve, is trapped into what's called a dual mandate. They have two tasks: price stability, making sure inflation doesn't run away, neither too hot, neither too cold, and support the labor market. Now, the easiest way for you to understand whether they are hawkish or dovish, so whether they are actually bullish or bearish for the currency, is to understand which side of the mandate they are prioritizing right now. If inflation is, let's say, 6% and the unemployment is 3%, then the Fed is going to be an inflation fighter. They will crush the market to lower inflation at all costs because they would be more than willing to raise unemployment in order to bring inflation down to a more acceptable level, to their target of 2%, for instance. And in order to bring inflation down, they'll have to raise rates or keep them high, okay? This weakens the economy in order to lower inflation. Now that's a hawkish central bank. Here's Powell saying it in his own words at the Jackson Hole Symposium in 2022. Now remember the context here. Inflation was running at 8% or so. It's a very powerful, very important historical speech.
We're going to hear from the chairman of the Federal Reserve. Let's listen in.
Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth.
This was one of the most hawkish speeches that Jerome Powell ever made. We'll use our tools to forcefully bring inflation down to 3%. Bringing inflation down to 3% would require a period of below-trend growth. This was an historical moment for Powell, with inflation running at 8%, labor market was around 3% or so. This was an historical speech, which it's an hawkish central bank. In fact, the result of this was the strongest dollar rally in 20 years or so. Now, understanding, being able to read between the lines of what Jerome Powell was said in that August in 2022 was pivotal, was key. The Federal Reserve went on to hike rates, meeting after meeting, 50 basis points hikes, 75 basis point hikes, pretty historical moment. And that was, in fact, quite a move in the dollar. Now, let's say instead that inflation drops to around 3%, but the unemployment rate is now up to 4.6%. Now, in this case, the context, as you can see, has completely changed. The Federal Reserve will try to turn around completely to support the labor market. So they'll cut rates or keep them low to inflation is not that a concern anymore, but they're gonna keep rates low or cut them to support the labor market, to lower the unemployment rate. This is a dovish central bank. Now here's in contrast Powell at the Jackson Hole Symposium in 2025.
Well, right now, let's take a listen to Jay Powell, chair of the Federal Reserve.
The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Did you see the difference there? Completely different speech, completely different forward guidance. Inflation not a concern anymore. Yes, upside risk, but the context requires them to adjust policy. Shifting risk balance may warrant adjust policy because the labor market is more of a concern than inflation is. So they have to constantly balance the two mandates: price stability, inflation, and labor market. So the message you need to listen for is which side of the mandate they're prioritizing right now. They're looking more at inflation or are they looking more at labor market? With that in mind, then understanding everything they say on top of that gets a lot easier. Let me show you. So we know that you have to choose a side, but they're not just going to come out and say, hey, we're worried about the labor market. Sometimes they do, but usually that's not how they do it. So instead, they use central bankers type of speech, academic speech, coded language, stuff like that. That's called forward guidance. The central bank's communication tool where they signal future monetary policy intentions, like interest rates movements, to influence economic expectations. So this is what a trained ear hears when the Fed or any other central bank speaks, to understand which side of the mandate they are prioritizing. All of these comments are projecting a focus on lowering inflation. For instance, we're worried about upside risks to inflation. Obviously means I don't care about what the labor market does, I'm raising interest rates to keep in mind. It's bullish for the currency. It would be premature to consider rate cuts. Stop thinking about rate cuts, it's not gonna happen anytime soon. Again, bullish USD. A restrictive stance is needed for some time. Don't look for a pivot too soon, don't look for rate cuts too soon. We're locked in a hawkish stance now. These are just examples, obviously, but these are real sentences that they use. And the overall message here is, again, caution about upside risks to inflation and caution about easing monetary policy. Too early, too soon, too much, okay? This is what we call a hawkish central bank. Now, if instead they shift the focus to prioritizing the labor market because they think inflation is good enough or whatever, then they'll use a language that emphasizes labor risk and caution. We're seeing signs of cooling in the labor market. Obviously means we're getting nervous a little bit about the labor market, so we'll probably cut rates. That's bearish for the currency. The risk to achieving our mandate are becoming more balanced. What Powell said at the Jackson Hole in 2025, the video I showed you earlier. Basically it means we're done caring about upside risk to inflation. Time to worry about the labor market instead. Bearish for the currency. We have to be mindful of undue tightening. Again, everything they're saying here is caution and fear about downside risk to the labor market, and they're projecting caution about, not tightening too much the economy, okay? When you hear this combination of terms, you're absolutely looking to show the currency. So see what's going on here. On one side, they're worried about inflation and not really concerned about the labor market. And on the other side, it's the opposite. Worried about the labor market, less worried about inflation. Now, if you want to be in the top 1% of traders, the guys will front run the news, the ones who know what the central bank is going to do before they actually do it. You don't just listen to what they say, you do that, but at the same time, you also listen to what they stop saying. Here's what I mean. Let's say for about 6 months, every Fed statement included the phrase, inflation remains elevated, the committee remains highly attentive to inflation risks. But then at some point, that sentence is gone, replaced by the committee is attentive to the risks of both sides of the dual mandate. They remove that inflation remains elevated. They remove that the committee remains highly attentive to inflation risks, and they replaced it with this. See the difference? Let me be a little bit more precise here. Let's say again that for quite some time, every Fed statement has included the phrase, the committee anticipates that ongoing increase in the target range will be appropriate. They're basically telling you, we think we're gonna keep hiking rates for longer. This was February 2023. At some point, just a couple of months later, that sentence gets watered down quite a bit. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the tightening of monetary policy, the lags in which the monetary policy affects. They're basically telling you, hey, we're not so sure we're gonna hike anymore, okay? This was June 2023, just a couple of months later. Just a change in the statement, just rephrasing, rewording. They removed that anticipating ongoing increases in the target range will be appropriate, and they watered it down. They put a lot of clauses in. They said, oh, maybe, maybe not. We're gonna be looking at the cumulative tightening, all that, okay? They basically watered down this strong sentence to this softer sentence. This was the very first official signal that the Fed hikes were basically over. Now, in fact, the dollar fell off on that. Markets sniffed out the pivot on the subtle change in statement, and immediate reaction was to go down, and then it kept trending lower. Now this is subtle, but it's one of the way the central banks sends its signals. The trend high registers this omission, this change in phrasing from highly elevated to this. And so they start to anticipate a pivot from inflation, from hawkish to the labor market, to a dovish stance. So with all this said, how do you apply this to your trading strategy? Well, this is all about understanding whether a central bank is hawkish or dovish. Remember, hawkish is bullish for the currency, dovish is bearish for the currency. So the main question to always ask is what the central banks is focusing on right now. Are they focusing on inflation or are they focusing on the labor market? Step one, you define the narrative. Before you even look at the chart, we ask, what is the Federal Reserve current priority right now? Are they fighting inflation? They're worried about upside risk to inflation. That's bullish for the currency. Or are they supporting the labor market? That's bearish for the currency. So hawkish on one side, dovish on the other side. So if inflation, for instance, is sticky and the Fed is saying that they're worried about the upside risks to inflation, then I'm only interested in buying USD, okay? Since I know that I want to buy the dollar, I'm ignoring every signal that says this is bearish. Just ignore it. I don't care if there's a double top. I don't care if there's a divergence. I don't care if they're at a size overbought. If the technicals give me a setup to the long side, I take it because it's a setup aligned with the macro flow. This is where all the difference is made. By understanding what I call the path of least resistance, we understand that the Federal Reserve is hawkish, so their action will likely strengthen the dollar. And so I want to only look for buy setups along this. I don't care if this pulls back a little bit. I don't think this is a top because I know that the macro context calls for this to move further up. Now, on the contrary, again, listen to Powell back in August 2025, where he did a massive pivot from upside risks to inflation to downside risks to the labor market.
Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment.
And notice, in fact, the dollar since then. Here we started to know that the labor market was weakening quite faster than anyone had thought. So the dollar already saw the pivot coming. And then in August, Powell confirmed that things were changing, the labor market was softening, and so their next move is going to be a cut. And in fact, the dollar priced that into advance. This is how you read a central bank. You look for whether they're focusing on inflation or the labor market. That way, you know if they're going to be hawkish or dovish. So I want you to know what side of their mandate they're most focused on. That said, if you want to trade fundamental analysis professionally, hit the like button below to get more educational videos like this.